Okay, what is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be doing some stock analysis for Tractor Supply stock because the stock is down a lot. I have not checked this stock in a while, and now that I just looked into it, the stock's down over 30% in the last month. It's down 41% in the last year, and it's down 22% off of where it was 5 years ago. So it hasn't hit this stock price since 2020. On a PE basis, it hasn't been this in like it's only been this cheap like once or twice in the last 10 to 15 years. So we are at extremely historical lows for this stock. And we're going to run through the numbers and see is this stock a good pick. So, as of 2 days ago, they declare a dividend. Now, if we look at what they've been doing the last couple of years with the dividend, they have cut it a lot. Which let's see, this says a dividend of 24, a quarterly dividend of 24 cents, which would equate to almost a dollar. And that's about what they're doing is almost a dollar. But look where it was. It was over $4 for dividends just 2 or 3 years ago. And now it's been cut by what, 80% or so. So they're still, and really the dividend is not bad. It's at a 3% dividend. That's really not bad. But it definitely has come down a lot, which I think ultimately is a good decision, being that their sales hasn't really been growing much. Their net income is pretty much flat. I think that's probably a good idea. So Tractor Supply is a $16 billion company, and if you want this dividend, pretty much you'd have to own the stock by May 27th. So you got like a little over a week. And then it'll be paid on June 9th. So for more than 85 years, this company has been passionate about serving the needs of farmers, ranchers, homeowners, and others. They are the largest rural lifestyle retailer in the U.S., ranking 296 on the Fortune 500. That's pretty good information. The company's more than 50,000 members deliver great service and help people get closer to the land, take care of animals, DIY lifestyle, blah, 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 blah. And they are also incorporating Pet Sense, which is a pet specialty retailer, as well as Alavet, which is a leading online pet and animal pharmacy. I actually remembered when they acquired that company. And so I think they have a pretty nice, circle of brands there. And they have over 2,400 locations in 49 states. So that's also good information to know. And if we come over here to Claude, which just to let everybody know, these LLMs make mistakes here and there. I think the main mistake that these AIs are making is the information for like what the stock price is sometimes outdated, like by like a year or so. And so that part I will watch out for. Other than that, most of everything else pretty much looks accurate. So like this is the revenue expectations going from 15 billion last year, that's about what they did. So let's say they're projecting 20 billion 4 years from now. Now, that seems kind of ambitious because they're being that their sales has been flat for 3 years now. But you never know. I mean, Yahoo has them doing about 5% revenue growth, which is not a lot. I understand that. I think they're planning to open like however many stores every year, 30 or 40 stores every year. So that's probably going to be driving sales growth. I think comp store sales were not up by that much. Like I want to say under like 1%. It was like 1% or something. So, but most stores are struggling with that right now. Like Chipotle, Target, there's a lot of retailers struggling with that. So keep that in mind. I think with them being, the largest company retailer in this space, over 2,000 locations, just that sort of network and that sort of just distribution and the effect that they can operate on pretty much the whole country. I always view that as a pretty nice advantage. And so unless we see them really losing market share, like as a permanent thing, then I'm not super worried. I'm actually considering buying this because this is kind of my type of investment where like when I see something at a stock at a 6 year low and I think that their dip in this isn't even a dip. This is just a flat graph pretty much. When I see sales flatline, but I think that it could return at some point in the future, or the way I view this is like when you're trading at 1 time sales and 14 times earnings, you've almost priced in anything that could go wrong, right? I feel like investors sold out of this because they feel like, this is like worst case scenario has been priced in. That's the way I see it. And then you look at this, this is pretty close to being accurate. Average PE of 20. A bull case would be if they trade it like 23 times, and a bear case is like 16 times. Because look at this graph down here. Here's the last 10 years of this PE. It's multiple times it'll hit around 30. Okay, that's like ultra bullish, which is not super realistic, but like 25, 20, even like 27 times is realistic if they have a good year. And on the bear side, we're looking at about 15 times. It's been right there. It hit that's a 18. Right now we're at 15, and it hasn't been otherwise. It hasn't been a 15 since only 2017 and 2020. So that would be the bear 15 times, which is where we're at right now again, and that's where we've been there twice in the last 10 years, and both times it shot up tremendously after that, right? Look at it, both times went from 15 all the way up to 25, 15 all the way up to almost 28. So that tells me that this is pretty much priced for failure, and it's priced like we're at the bottom. That's exactly how I view this. Now, if their sales were to keep going down big time and it just really looked like they were losing market share and their margins were getting destroyed, well, sure, maybe then it goes down to 12 or 11 times earnings or 10 or something. But I don't think that's realistic. Free cash flow yield is right in the middle, so not great, but not bad. Price to sales, this graph is also cheap. So you're getting this at a historical low valuation, and that's why I kind of like it. Now, these are the charts. Well, see, actually, although some of this doesn't look great because the business peaked in 2020, the other way I see this is so see, like Q4 is their weakest year or weakest quarter. And if you look at like, okay, so they were doing, let's see, Q4 was 6%. Then it will actually, I guess, let's see, that's Q1. Okay, that's Q1. So if we compare, oh, why does it go from Q4 to Q1? This is probably Q1 here. So 5%, 5%, 5%, and then it goes to 4%, which is a bad trend. But if you look back, I mean, there's also times where like even if it dips at 3 or 4%, it also can come back, and go right back up to 5%. So keep that in mind. But generally, yeah, I mean, the ROI numbers have not been great for this company. It's been downtrending now for 4 years. So it's not great. But like I said, a lot of times this is like something I'm interested in taking a chance on because the way I look at it, we can keep going down here, but okay, so here's a graph with some estimates. Look at the base price, bull price, and bear price. These are EPS estimates. Pretty, again, it's only 5% revenue growth, which is what they're on track to do. The EPS jumps are pretty small. Nothing, it's definitely realistic. And so let's say, I hold this until they're doing $3 EPS, or maybe I hold this for a year or two. I don't know. But the point is, even if we take two times earnings, so I mean they're doing two. They did two last year. They're going to do a little over two this year, and then 2.3. So pretty slow growth, but still, the point is they're still growing. Okay, it's not like a dying business. But if you take that $2 EPS, and then like we just looked at for price to earnings, we're at the worst case scenario, right? So two times, let's say we do two times two or 2.2, which is their average EPS over this next year or so, times the 15 where we're at right now. That's $33. That's right above where we're at right now. That's worst case scenario. Now, could it go down again, like I said, could it go down to 10 times earnings? Yes. But is that super realistic? I say no. I would say this is the bottom because this is where the bottom has been twice before in the last 10 years. And for 95% of the last 10 years, this stock has traded above 20 times earnings, right? And on average, if you were to take the average, I would put it right here in the middle somewhere, right? I would say it's about a 21 or so, maybe a 20. Here's 20, and that's definitely on the lower end of the chart. So I would say like 21 is right in the middle. So 21 times 2.2 gives us a $46 share price, which is a 50% return. That would be my guess for where the stock is going. I would say a 50% return is very realistic. So that's why I'm buying this. Of course, there is the risk the stock keeps going down, and that's why am I going to put, maybe I'll only buy 70% of my position, and then if it goes down to 25 bucks, then I'll buy the other 30% of my position. That's kind of how I view this. So like I might buy, like, let's say I might buy 3 grand worth of this, and then if it goes down to 25 bucks, then I'll buy another $1,000. That's kind of how I look at it. So yeah, I mean, this is my opinion on Tractor Supply. I mean, again, you're getting a 3% dividend. Don't forget about that. A PE of 15, which is super cheap. It's definitely cheaper than the rest of the rest of the market right now. And it's not a lot of growth, but they're still growing 5%. And so it just seems like a low risk thing. And especially when I just run the numbers and we're just taking average, just super conservative average numbers of 20, 21 times earnings times the $2 EPS, we're looking at a 50% return. That's pretty conservative, and it seems like a pretty safe bet, pretty safe valuation. So anything could happen. There's always risk of stocks going down more. I mean, look at Adobe. Adobe, you could argue, is trading below where it should be, but still there. So that is my analysis for Tractor Supply. Let me know what you guys think down below. Otherwise, I will see you in the next video.